Okay, let us start. Okay. So in the previous video, we finished with the concepts of chapter 7. So in the today's class, we are going to start with the concepts of chapter 8. So one of the important chapter from the exam perspective, we also have a numerical problems here, and we will also get a conceptual questions here. Okay, totally there are 3 units in the chapter 8. So unit number 1 speaks about the money demand, unit number 2 speaks about money supply, and unit number 3 speaks about monetary policy. So without wasting the time, let us get started. So unit 1, money demand. So why do we need to demand for money, or what exactly does money refers to? See, as a policy purpose, money is called as a set of liquid financial assets. Any variation in the stock of money will always impact on the nation's economic performance. So when we speak about the money, we also call it as a legal tender. Money is nothing but what? Legal tender, which is generally used as a means of payment, store of value, medium of exchange, medium of transferring the purchasing power. So these all are the characteristics of the money actually. But whenever we ask students, what do you mean by money? Sir, money is a standard payment, money is a store of value, medium of exchange. These all are characteristics. So what is money? Money is a set of liquid financial asset. So if we go back in the earlier days, we had a barter system. From the barter system, we came into a coin system. That means gold coins, silver coins. From that, it was heavy. Like we were, let me say, not able to carry every single place. And that had a very inconvenient way of like carrying every single time. So they deposited those, let's say for example, coins, golds, everything in the bank, and the acknowledgement letter that which is backing that gold. Now we started trading with that. That is when eventually the paper currency came up into a picture. That is what we call fiat money. In short, fiat money is nothing but materially worthless, which is considered as a legal tender. That means whatever the currency note today that we are using, that is called as a fiat money. Materially worthless. That is just a sheet of paper. Law recognizes that as a legal tender from the eyes of law. If law stops recognizing this as a legal tender, it is no more considered to be a money. And this is where usually in your exams, the questions will come. So from the nature of money and the general characteristics of money, which among the following is not a general characteristics of money? They will give this is one of the most repeated question. Easily reproducible, but it is not easily reproducible. See, it is difficult to counterfeit. That means you can't easily duplicate it. It is generally accepted as money within the political boundaries of the nation, which is durable, long lasting, effortlessly recognizable. Every 100 rupee note looks the same, difficult to duplicate it, and it is relatively scarce, portable, easily transportable. It is possessing uniformity. All 100 rupee note looks the same, and it can be divided into a smaller parts without losing any kind of a value. So this is where usually the general exam questions about the money is going to come. General characteristics and as well as the nature, which is generally accepted, holding in the form of money. It has got purchasing power, one of the most highly liquid asset. Money has no internal value. That is what we call fiat money. It is acting as a legal tender. Money need not be always a physical item, and role of money is used in an economic transaction. Okay, so today I solved PYPs, only few. Some I was unable to solve. I got some fear. What I have to do, sir? Last 10 days, what should I do? So no new experiments and all. First have a conceptual clarity. That is most important there. See why you went wrong. Like, was it concept or was it silly mistake? Just identify that, Raj. That is most important. Okay, chalo. So in that, functions of money, same 11th and 12th standard topics. So this is where you have to just go through like a read-only concept. But these two, as I said, this is where exam questions will be coming up the most. Nature of money and general characteristics of money. Okay, chalo. Now, why do we need to demand money? See, demand for money is basically for two kinds. One, liquidity preference, in order to hold a liquid money in hand. Second one is a derived demand. So that means we need to buy goods and services for which we need money. So we are deriving the goods and services demand. For that we have a derived demand. Second one, liquidity for emergency purposes. So these are the two main demands for money. One is demand for liquidity. Second one is demand for goods and services, that is storing the value. So for a day-to-day transaction and determinants of money, money will be in the form of, let's say, for example, when you earn more income, you need more money to buy more goods and services. Higher your income, higher will be your expenditure. You need more money in your hand. And it acts as a general level of price. Everything is quantified in terms of price. Rate of interest will affect on the holding of money. That is what Keynesian theory is all about. I will explain about this. It acts as a degree of financial innovations. That means if new, let me say, innovations like UPI payment, internet banking, if these things are in day by day increasing, people don't like to hold money in cash. Rather, they will deposit in the bank and they will like to do the online transaction, and that forms part of a real GDP. So these are the determinants of money. Now let us go to the heart of the chapter. Theories of demand for money. So there are 3 plus 3 theories. Total 6 theories are there. So 3 plus 3. So total 6 theory. These 6 theories are most important. Okay, no sir, I got correct answers, but able to solve only few. Like that, when you practice it, eventually you will increase, Raj. No worries. Like, don't get like offended over there. Like, slowly you will improve it over there. Sir, I finished Jan 26 marathon today. What should I do next to score at least 65? Okay, Sanya, Banu, start solving more and more MCQs. RTP, MTP, and PYPs. These are the main priority. And even ICA material, we have a mock papers. There are 9 mock papers. You can cover those 9 mock papers. Okay, Sudarshan. Okay. So 3 plus 3. So total 6 theories are there. So first three theories are extremely important. First one, QTM, quantity theory of money. This was followed by classical economists, the one who was before 1929, who said that government intervention is not required, economy will self-adjust. Even that was also supported. Even this QTM was also supported by the neoclassicals. That is after the Great Depression of America, one who spoke about the government intervention is necessary, all those. So let us get started. So very first one is a QTM, quantity theory of money. See here now, one of the most important and the simple topic here is MV is equals to PT. See, let's say money supply and the price of goods, number of transaction and velocity. See, this is on the demand side, price into transaction. This is on the AD side. Let's say I'm buying a chocolate to give it to my wife. Let's say the price of a chocolate is 100 rupee. I'm buying 5 times in a week. So 100 into 5, rupees 500. So this is the total demand. But QTM never focuses on demand side much. It will focus on the supply side. See, this M stands for the money which is in the circulation. Money supply. Consider it as money supply. That P is a price over there. This is the price. We also call it as P. Here it is a transaction. This is called T. So the money supply, whatever is available in the economy, that has a direct connection with the price level. Let's assume that in an economy, there is only and only 80 rupees available. If the product price is 100 rupee, where will they buy the product? So even money supply should also become 100. Only if this is also 100, if price is 100, demand gets generated. And number of times we are buying, that is equal proportionate to velocity. Even this is called velocity. V. So even this will be like 5 times. So totally the aggregate supply will also become rupees 500. So this is AS side. So MV is equal to PT. MV is equal to PT. This is with respect to actual money. Now we don't just keep money in our hand. We also keep it in bank. So for this we have a credit money. Credit money. We call it as M dash. And even that credit money will also have a credit velocity. Even that money will undergo a circulation. The money which is in bank, in the form of loans and advances. So this is V dash. So the actual formula is not just about MV. So it is MV plus M dash V dash is equals to P into T. So this is actual and credit money. So this is the formula. So entire QTM is focusing on the supply side. It is not focusing on the demand side. It is completely focusing on which side? Supply side. So that is the concept of QTM, quantity theory of money, which is one of the oldest theory, which was published in 1911 by Irving Fisher of Yale University. And the book written by Irving Fisher is a purchasing power of money. And it is supported by whom? Classical economist, and also supported by neoclassical economists. Even neoclassical supported. Later they came up with their own theory. So this is QTM theory. See, MV is equals to PT. Later actual money, credit money, both put together. MV plus M dash V dash is equals to PT. And with respect to just actual money, MV is equals to PT. Clear? So this is the theory. You need to understand this formula. This formula, they may also give you numerical problems from this area. Let me show one of the numerical problem, how exactly the questions are going to come. This is how. Observe. See, in an economy, the money supply M is 500 crores and the velocity of money is 5. So write down, you already know the equation. So money supply and price level is directly connected. Transaction is collected with velocity. These two are interconnected. Now the money which is available, which is 500 crores, and the velocity of money is 5 times. So 500 into 5, 2500 crores. That means even this transaction that is on the AS side, if it is AS is 2500, AD should also be 2500 crore. So see there, the total number of transaction is 10,000. So they have given this total number of transaction 10,000. Now they are asking us to identify this price level. Very simple logic it is. 2500, we already know this, that is MV. So price level will be MV divided by T. That means 2500 divided by 10,000. So in this case, the answer is 0.25. Now 0.25, and observe, in the question they have given in terms of crores, but options is in thousands and lakh. We need to reduce it to the decimal value. From crore, the very first decimal value will be lakh. So 0.25 is 25 lakh is the answer. So like this, the numerical questions will also come from MV is equals to PT. Is that clear? So next theory is a neoclassical approach, wherein which now money, they said, is not only just used for a transaction purpose. See, in case of QTM, here money is only and only used for a transaction purpose. Other than transaction purpose, money is not used for anything else. But in case of classical approach, neoclassical approach, or Cambridge approach, which is also supported by, see, Alfred Marshall, A.C. Pigou, Robertson, John Maynard Keynes, they say money is used for both transaction purpose as well as precautionary purpose for some unexpected emergency, or tomorrow price may increase for the goods. I have to buy the goods, right? If price goes up, I need more money to buy the same goods. So I will use it as a temporary abort of wealth, that is temporary store of wealth. So money is used for both the purpose, transaction as well as precautionary. So money demand is the proportion of nominal income. So here the formulas are important. You need to know what is that K, what is P, what is PY, and what is only Y. All this MD, money demand, is a proportion of PY. PY stands for nominal income. Only and only Y is a real national income. Once in an exam they have asked from the question, only and only from this Y, not PY. Y stands for real national income, but PY stands for nominal income. So money is used for both the purpose, transaction purpose as well as precautionary purpose. So this is neoclassical approach. Next comes the difference between QTM and Cambridge. See, QTM focuses on supply side, but Cambridge focuses on demand side. QTM money is only used as a transaction, that is flow, but here along with transaction, precautionary, along with flow, stock concept. Money is only used for a medium of exchange, that is only transaction purpose in QTM, but here transaction as well as precautionary purpose. We are also storing it. Is that clear? So this was the first two theories. Sir, how many attempts should I solve? At least past 5 attempts, past 5 RTPs, past 5 MTPs, and past 5 PYPs. That is recommended. Sania Banu. Yes. Chalo, let's continue. So the third and the most important theory, that is Keynesian theory. See, in case of a Keynesian theory, there are 3 main purposes: transaction, precautionary, speculative. And the first two, that is transaction and precautionary purpose, is dependent on income. If you earn more income, you will spend more money to buy more goods and services. If you are earning less income, you will spend less money on goods and services. But the speculative money, this is what is dependent on interest rates. Speculative money is dependent on interest rates. Clear? So now, how exactly the speculative money is dependent on interest rate, and moreover, this is negative relation. Interest rate and speculative demand for money, but income and transaction precautionary motive, it has positive relation. For us, the speculative demand for money is most important. See, John Maynard Keynes, the speculative demand for money, this is also called as liquidity preference theory. This liquidity preference is a term coined by John Maynard Keynes, and this is what the exam question once they have asked. Clear. So the term coined by John Maynard Keynes, that is a demand for money from Keynes' perspective, is called as liquidity preference. And money is used for a transaction, precautionary and speculation. Transaction means to buy goods and services. Precautionary, to keep aside for some emergencies. Speculative, for the investment purpose. So for investment purpose, interest rate is the main determinant factor. Let's take up one example. Assuming I'm investing on a bond market. So the returns on bond is interest. Let's say the bond price on 1st of January 2027, consider 2027, which is 100 rupee. The interest rates in the market assume 10% high interest rate. Now when interest rate is high, you tell me speculative demand, will you keep money in your hand? Simply that money in your hand? No, because interest rate is high, opportunity cost will be high. So you will keep less money in your hand. Speculative money will become less when interest rates are more. See, this is what we said, inverse relation. Now only consider these two. Interest rate and speculative demand. Same way, after 6 months, let's assume on 1st of July 2027, bond price will become 500 rupee and interest rates will become 4%. Interest rate is low. At that point of time, you will convert back whatever you invested at 100 rupee, now it is 500 rupee. You will convert that back into your cash. That means now speculative demand for money will go up. So these two, speculative demand and interest rates, are inversely related. When interest rates are high, you will not keep cash in hand, you will convert that into bond. Same way, when interest rates are low, bond prices will be high. So you will convert that back into speculative demand in your hand. So will you keep money in hand or not? That is what speculative demand for money in your hand or not. When will you keep money in hand? When interest rate is low. When you will not keep money in hand? When interest rate is high. So interest rate and speculative demand for money is negative related. Same way, bond price and interest rate is also negatively related. If bond prices are less, interest rate will be more. If bond prices are more, interest rate will also be less. But in speculative demand, this is to what we will compare as a negative relationship. So this is what a speculative demand for money overall all about. See, transaction already we spoke, but remember the formula. From this formulas also the questions will come, the components of formula and precaution. But now for us important is speculative motive. Speculative motive refers to people's desire to hold cash in order to equip themselves to attract a investment opportunity for which they need a cash expenditure. What is that investment opportunity? Now I am on 1st of January. Presently the bond price is 100 rupee. In future it will become 500, or in future the interest rate, which is 10%, will become lesser. Present investment is to take advantage of future changes in bond price or future change in interest rate. I am investing at present to take advantage in future. What is that? Future change in bond price or future change in interest rate. That is what is speculative demand for money. See here, according to Keynes, people will hold money balance to take advantages of dash change, future change in rate of interest, same as future change in bond price. This implies Keynesian theory, rate of interest is the real returns on the bond. Yes, when we are investing on the bond, returns what we are expecting on that is a interest. See there, if you simply keep money in your hand, that money will not give extra money. So the returns on them simply holding money is zero. But if you invest it on bond, now you will get interest, or else you can also get capital gain. Suppose if you sell it, when you invested 100, now it is 500. When you sell this, 400 rupee capital gains will be getting. Or you will get a 10%, 4% as a returns on your investment on bond. Either interest returns or capital gains. See there, speculative demand for money and interest rate is inversely related. Same way, bond price and interest rate is also inversely related. See, when the current rate of interest is higher, present rate of interest, let's assume it is 10%, but you expected it to be 6% critical. But present rate of interest is high, now will you keep money in hand? No, convert it into bond. See, at the high rate of interest, will convert our cash into bond. Now reverse. If the current rate of interest is low, suppose if the current rate of interest is only 4%, but you expected that to be 6%, but interest rate is low, now you will convert back bond into cash. See, at the lower interest rate, you will convert the bonds back into a liquid cash. So when the high interest rate is there, You will not keep money in your hand, rather you will invest. See, higher the interest rate, lower will be the demand for speculative money. And increase in income will also increase transaction and precautionary, first two purpose, which is dependent on income. When your income goes up, transaction purpose, precautionary purpose will also go up. But speculative motive is dependent on interest rate, not on the income. Clear? So this is speculative demand for money. See, when interest rates are high, automatically your money holding will be zero. See, x-axis is money holding, demand for money. When interest rate drops down, you will hold money in hand. If interest rate keeps on decreasing, you will keep more money in your hand. Suppose, let's assume if interest rate is 10% in the market, you will not at all keep cash. You will completely hold it in bond. If interest rate becomes, just assume 7%, you will invest more money and you will keep less money in your hand. Suppose if interest rate becomes 5%, like 50-50 you will do. If interest rate becomes just 2%, you will keep more cash in hand and very less investments into the bond market. So that is what is a depiction. Connecting to this, there is one more topic called as liquidity trap. As the name says, liquidity trap. Money is getting trapped into the hands of people. Liquid money is getting trapped when interest rate is almost to zero. See, when interest rate becomes almost to zero, 0% interest rate, whatever money that has been pumped into by a system for a purpose of investment purpose, that will become perfectly elastic. It will become E is equals to infinite. So the money which is pumped into the system for the purpose of boosting the investments, that will not work now because interest rate is almost zero, like 0.5%. Like it is almost 0%. At that point of time, better rather than investing money, you will keep it in hand only. So speculative demand will become perfectly elastic. The third purpose, speculative demand. See, the speculative demand will become perfectly elastic or parallel to which axis? Parallel to x-axis. So this parallel to x-axis. Speculative demand for money will become perfectly elastic with respect to the interest rate. That interest rate is almost zero. And this situation is what we call liquidity trap. In real life, Japan has experienced this Keynesian liquidity trap. Even today, interest rate is hardly 1% here. If you observe 6 months back, it was hardly 0.7. Another 3 months back before, that means, let me say totally 9 months back, it was hardly 0.5% in Japan. The bond yielding rates, everything. See, for a 10 years, Japan's 10 years yielding dropped to record dropping 0.2%. Who will invest, man, if it is just 0.2%? This is the concept of liquidity trap. So these are the first three theory. QTM focuses on supply side. Second one, what is it? Cambridge approach, focusing on demand side. But Keynes is most important. Liquidity preference for money, wherein which money is used for all the three purpose: transaction purpose, precautionary purpose, and speculative purpose. Clear? So flip back, have a look. Any doubts? Let me know. So YouTube live students, any doubts in this? Sir, I attended ArivuPro quiz. I got 60 to 70%. Is it good or not? It's good, but you have to improve. Slowly you will improve. Take up more MCQs like that. Yeah. Okay. So post-Keynesian theory. See, after Keynes, the speculative demand concept was further elaborated and explained by another three more persons. So in that inventory approach, Friedman's restatement theory, demand as a money towards behavior as a risk. These are the three theory. This is continuation from the Keynesian speculative demand for money. The first and foremost, inventory theory approach. Here, Baumol and Tobin said money is like any other inventory, like closing stock in a business, like how we have an inventory, like that money is also like an inventory. But every time when you convert it into cash to bond, let's say for example, cash into bond or bond back into cash, there is a brokerage charges. So make sure that you are not converting more times and end up paying more and more brokerage charges. So you have to make sure that your investments from the bond should be higher rather than paying brokerage charge. See, without converting this, if you simply keep money in your hand, opportunity cost is there. Your money will be eaten by inflation, opportunity cost is there. But when you are converting cash to bond and bond to cash, that is when brokerage charge. So don't convert more times. Whatever is needed for your entire month, sufficient money, you hold it aside. Anything over and above that, you convert it into bond. And once you get a better returns from bond, then you convert back into cash. So you will only pay brokerage charge at one cycle. Suppose if you convert this more number of times, you will end up paying more and more brokerage charges. Whatever money you are earning in the bond market, most of things you will lose it in paying brokerage charge. Without doing that, if you simply silently keep money in your hand, you have an opportunity cost by simply holding money. That is what is explained by Baumol and Tobin. They said money is like any other inventory. See there, in this approach, money is like a real cash balance. It is viewed as an inventory held as a transaction purpose. Money is like an inventory, closing stock, held for a transaction purpose. The transaction is converting money to bond, bond back to money. And there is a fixed cost for making that asset into alternative investment, that is called as a brokerage charge. The most liquid asset is money, but it is also having a trouble. If you simply keep opportunity cost is there. Sir, can I keep it in bank account? Yes, safe asset, bank account, you will get some interest. If you keep it in demand deposit, you don't get anything, current account. Only when you keep it in savings account or bank FD, you will earn money there. So application of Baumol theory, same, just like how I explained, the opportunity cost is there. Either you can keep currency in your hand or demand deposit, you will not get any interest. But if you keep it in savings account, you will get some interest. If you want good returns, bond market or stock market, you should put, but that is also risky. You may also lose up your invested money. So risk is more, reward is more. Same thing is explained here in detail. So every time when the brokerage charges increases, number of times your conversion will go down because you will end up paying more brokerage charges. So that is inventory approach. Okay. Let's go to the next one. So Friedman's restatement of quantity theory. Very simple topic here. Milton Friedman said we should consider future income's present value, not present income. Now let's say for example, now Shashikiran said 1 plate pani puri today. Assume in 2026. 1 plate pani puri, let's assume it is 40 rupees. In 2030, same 1 plate pani puri will be 100 rupee. That means in future, what is 100 rupee? That is today 40 rupees. Same way, let's assume in 2030, you are going to earn 1 lakh rupee. That is in 2030, right? But present value in 2026, how much is that? Now, let's say, for example, this is 40,000 rupees. Like this, whatever you are going to earn in the future, we need to bring it down into its present value. And then we should decide, should we invest it or not? Is it good investment or not? Let's assume I want to buy a land. I want to invest it on a property. Presently, the land value, let's say I'm getting this land for some 50 lakh rupees. In future, by 2030, this will become 2 crores. You will be like, sir, amazing, sir, in just 4 years, your money has become 4 times multiplied. When I convert back this into present value, this 2 crore rupees of land worth in future, present value, let's assume its present value is 70 lakh rupees. Good, na? Present value is 70 lakh, but at present I'm getting this for how much? 50 lakh rupee. Good. This is called good investment. Suppose just assume this present value is 40 lakh, but presently you're buying it for 50 lakh, not a good investment. So like this, Milton Friedman considered the present income or future income. Future income's present value. But Keynes considered just a present income. That is the main difference here. See, we have to consider all our permanent income based on 5 asset class. Which are those 5 asset class? Money which is kept in hand, bond, equity, physical capital and human capital. And we need to bring it down to its present value. See, permanent income in future, whatever you will earn, divided by discounted rate. Same like our GDP deflator concept. So bring it down to its present value and then take a decision, because your money will be eaten up by inflation. There is a positive inflation rate year by year, because of which your money value will go down, and nominal demand for money has a positive relation with price. If price increases, value of that asset will also increases. Same way, there is an inverse relation with opportunity cost. The more the opportunity cost, lesser should be the money holding in your hand. You should invest more. So this is what is explained by Milton Friedman. So Milton Friedman said we should consider which income? Permanent income. But Keynes considered only present income. He analyzed only in the present scenario. Keynes never considered about a future scenario. But who is considering future scenario? Friedman. And that too in future, which income? Permanent. Whatever total income that we are going to earn in the near future. That is Milton Friedman's restatement of quantity theory. Last but not the least, behavior towards risk. James Tobin. See, James Tobin said, see boss, as an individual, what extent are you ready to take a risk? What is that risk taking ability that you have got? What all are the risks that you are planning to take? That he will be explaining upon. See, very simple concept here. Tobin said, see boss, as a risk averter, as a risk taker, you have 4 options. Either come up with your portfolio of asset in a combination of safe as well as risky asset, 50% safe, 50% risk, or else slowly start taking risk, slowly start investing on bond equity, like this. Slowly start. First you keep money in hand, later keep money in bank account, later you invest it on gold, later you come to mutual fund, later you come to equity, like this. Slowly, step by step you take a risk, low risk to high risk. This is what we call risk aversions. This is what is recommended for risk aversion. Get aware of it first and then slowly you invest. Later, there is one more category, high risk category, more risk to less risk. Straight away enter equity market, straight away enter bond market. Later, you will cut down things. That is more to less. Or I don't even want a risk at all. Zero risk. I know that if I simply keep money in hand, it will not put extra money. I will have high opportunity cost, but still I'm okay with that. I'm okay with opportunity cost. I don't even want any return. Everything I will keep it in my hand without taking any risk. That is zero risk. So 4 options are there. When you have money, whether to invest or not, what to invest, in which to invest, what kind of risk to be taken, 4 options. Combination of safe and risk, or low risk to high risk to low risk, or zero risk. So these are the 4 options given by the Tobin. See, an investor is going to face a problem within what proportion, that means in what combination of my portfolio in the financial asset should we keep it in the form of ready money and some other interest bearing alternative investments such as bond. How much should I invest? How much should I hold in hand? How much liquidity should be there? How much liquidity should not be there? In what combination? So 4 options are there. So this is a combination as per the Tobin. Clear? So by this, unit 1 comes to an end. That's it. This is unit 1. Nothing big or nothing much in the unit 1. So mainly first 3 theory. QTM is important. Cambridge approach is important. And Keynesian theory is important. See, in QTM, money is only used for a transaction purpose. In Cambridge, transaction and precautionary purpose. Precautionary means saving purpose for some emergency. In Keynes, transaction, precautionary and speculative. Speculative means for investment purposes. So speculative is mainly dependent on interest rate. But first 2, transaction and precautionary is dependent on income. If income increases, those expense also increases. But interest rate is negatively related with speculative demand for money. So this alone logic you have to remember. Clear? So this is unit 1. So first I will finish the entire revision of the chapter and together I will go with MCQs rather than going unit wise one by one. Clear? So flip back the page. Our YouTube's live students, any doubt in this unit 1, let me know before moving to unit 2. Okay, I will help you. Don't worry. MCQs or MCQ PYP, right? I will help you out. Okay, then let's continue. So most of the numericals what we get will be from this particular unit in the chapter 8 actually. M1, M2, M3, M4 calculation, money multiplier calculation, credit multiplier calculation. All of this will come from the unit 2. One of the easiest unit. Okay. Then let's get started. Okay. Now unit 1 spoke about money demand. Now unit 2 speaks about money supply. So what is the supply of money? So there are mainly 2 sources of supply. Straight away let me go to supply sources. For a better understanding, I will come back to intro part. We should explain meaning of public, and from that public also numerical problems will come. Clear? Okay, so the primary source of money supply is always a central bank of the nation. The money which is issued by the central bank is called as fiat money or high powered money, or we can also refer it as monetary base. These are the 3 different names. And every money that is printed and circulated by, once again about inventory theory. See, in inventory theory, money is like an inventory. We are holding money like a closing balance. We are investing that. How much money to keep in hand, how much money to invest. Okay. Okay, Sankul, I will explain about it. First listen. Okay, so the money which is printed and circulated by RBI, that is the responsibility of an RBI and government, and that comes as a liability with them. And this money will always have a backup. Whatever, even a single rupee that is printed, that will have a gold reserves as a backup or forex reserves as a backup. But money which is created by the credit money, that is commercial bank money, now that doesn't have any kind of a backup. So this is given in the form of loans and advances. Now let's take up an example. See, let's assume Shashikiran. Now I will go and deposit some 1000 rupees in my bank account. Let's say I will go and deposit 1000 rupees I deposited. Now out of this 1000 rupee, now RBI might have instructed to every commercial bank, you need to keep a reserve. You can't give away the entire money what you guys receive as a deposit as a loan. Let's say reserve is 10%. That means in that 100 rupee bank will keep aside, and the remaining balance, that is 900 rupee, this can be given as loan. Just assume Mr. Dhoni uncle will come and borrow loan from the bank A. This is bank A. Now he got 900 rupee as a loan. Now Dhoni uncle can also withdraw 900 rupee. Now he has got a loan account. And Shashi uncle, even he has deposited 1000 rupee. Now even I can withdraw 1000 rupee at any point of time whenever I want. That means in reality, bank is only having this 1000 rupee, but claim is 1900. That means Shashikiran can also withdraw 1000. Dhoni uncle can withdraw 900. But in reality, bank has only an asset of 1000, but liability of 1900. So 1900 liability, 1000 asset, extra 900. Where did this come from? That is what this is credit money. This doesn't have any kind of a backup or a reserve. This is what credit money created by the commercial bank in the process of lending and borrowing. Now let's say Dhoni uncle will go and buy some goods from Mr. A. Now Mr. A will go and deposit this 900 rupees in his bank B. So this is bank B, the second bank. Now again 10% reserves. 90 rupees is kept aside. Remaining 810 rupees will be given as a loan. Now let's assume Kohli uncle, for a shoe manufacturing business, he will come and borrow the loan. How much? 810 rupees. Same way, he will go and buy some goods from Mr. B, a raw material vendor. Now Mr. B will deposit this to bank C. How much? 810 rupees. Again from this 10% reserve, that is 81 rupee. Remaining money is 729. So the 729 is taken as a loan by Hardik Pandya uncle for his cricket practice for the upcoming World Cup loan. He wants to buy some cricket kit. Again, Hardik Pandya uncle will go and buy some goods from Mr. C. Now Mr. C will come and deposit this 729. Like this, the process keeps on continuing. So this is what the credit circulation will happen. We'll explain about this. This is what is called as a credit multiplier concept. At the moment, just understand the first two scenarios. Shashi uncle and Dhoni uncle example. At any point of time, bank's assets will be lesser, but bank's liability will be greater. So this is the credit money concept. Money created by the commercial bank. Clear? So there are mainly two sources of money supply. One, central bank source. Second one is a commercial bank source. Commercial bank source in the form of credit money in the process of borrowing and lending transaction to the public. Central bank by issuing a fiat money, that is high powered money, by printing the currency and circulating them. So with that respect, whatever the currency note that is printed and circulated into the system, that is what we call stock concept. Out of that, money which is available with the public, money which is available with the public in the public hands for their transaction purpose, that is flow variable or a flow concept. Now in an exam, they will ask you to find the numerical from the public. See, first understand who is called as a public. Rather than understanding who is called as public, it is easy to know who is not called as a public. Producers of money. In our country, there are two important producers of money. That is government and the banking system in the country. Except these two stupid fellows, now everyone else will come under the definition of public, including foreign central bank, foreign government, International Monetary Fund, World Bank or Asian Developmental Bank, who is keeping Indian money with the RBI, that is also public money. Any non-banking financial institution, local authorities, all this non-departmental public sector, everyone will come under the definition of public except producers of money. In India, who are the producers of money? Government and the banking system. These two are the producers of money. Except these two people's money, like one bank keeping money with another bank, interbanking deposit, money held by the government, money belonging to the banking system are not included in public definition. So they are not a definition of public. So from that, usually numerical problems will come. Let me show that. Chapter 8. Yeah. See here. Calculate currency with whom? Currency with public from the following data. Simple. Whatever is in the money in the hands of public, add it. Whatever is belonging to the banking system and the government, subtract it. Simple. See, notes in circulation, add. Circulation of rupee coins, add. Small coins, add it. But cash on hand with whom? With the bank, subtract. Add the first three, subtract the last one. That's it. Simple. Next. One more I will show. See here, calculate currency with public. Notes in circulation, add. Coins in circulation, add. Cash on hand with whom? Bank. Subtract. Cash on hand with whom? Coins on hand with whom? Bank. Subtract. So first to add, next to subtract. That's it. This is how easy it is. From this is how the questions repeatedly are coming. See, there is calculation of public now. Repeatedly it is coming. And whom do we call as a government? Government, nothing but central government and state government and all local bodies. Banking system, Reserve Bank of India and all those banks which comes under Reserve Bank of India, one who accept CASA deposit, current account and savings account deposit. CASA stands for. They are coming under the definition of banking system. Clear? So now straight away we'll go to the concept of CBDC. See, CBDC is something but e-rupee. Now going further, we are not going to print currency in the form of paper currencies. Going further, we will come with more of digital in form. Already that is legal tender from 2022, but most of them doesn't even know about it. See, CBDC of RBI. Second. See, this is the one. This is CBDC. Oh, LinkedIn is going. One second. Okay, we don't want you. Cancel. Just a second. I will just show you the image. Yeah. Yeah, see. This is CBDC, Central Bank Digital Currency. Rather than printing in the form of paper, we have issued in the form of digital way. So going further, this will be the legal tender in the country. Already it is a legal tender, but usage is very minimal. So up to 500 rupee notes, see 2 rupee, 5 rupee, 10, 20, 50, 100, 200, 500. Coins is 50 paisa and 1 rupee. This is CBDC, already a legal tender. Instead of printing in the form of a paper, we are issuing in the form of a digital way. And in India, remember, cryptocurrency is not a legal tender. That is not legally recognized as currency in India. So that is coming under the asset classification. So RBI has barred anyone from virtually dealing with the cryptocurrencies in India. So crypto does not have legally recognized as money. It has more uncertainty and that is not legally recognized as currency in India. It is an asset classification, like how we hold gold, silver, building, car, like that. Crypto is an asset classification. So that is related to CBDC and crypto. Next comes, this is where the most important topics are. Measurements of money supply, M1, M2, M3, M4. This formulas you have to remember. This is the utmost important. From this, usually the exam questions are going to come. This is where the main exam questions will be. M1 as 3 component, currency, notes and coins with public, demand deposits with the banking system, that is CASA deposit, other deposits with RBI. When you add this 3, you will get M1. M1 is also called as a narrow money, or it is the most liquid. M1 is narrow money, or M1 is also called as a most liquid money. M3 is called as a broad money, and M4 is a least liquid. Clear? So M2 is M1 plus savings deposit with post office savings bank. All those money which is saved in a post office bank. M3 is M1 plus time deposit, net time deposit, whatever FDs that we keep it in the bank. M4 is M3 plus total deposit, including savings, time, whatever, certificate of deposits, total savings of the post office organization minus NSC, National Savings Certificate. NSC stands for. So what is this? General public money, government will issue as a bond or government will issue a certificate and they will raise the funds. Tax-free money, that is. Whatever interest they earn from that. That money is not used by the public. That money is used by the government. So those money should be subtracted from M4. So M3 plus total deposit with post office savings organization minus NSC, National Savings Certificate. So this is the formula. From this, numericals will also come like this. I've given in the class like all 4 calculation, M1, M2, M3, M4, or just one calculation, M1. See, let me show the exam questions also for your better understanding. See here, calculate narrow money, M1, from the following data: currency notes and coins with public added, demand deposits with the banking system added, other deposits with RBI. Only 1, 2, 3. We only need these 3 things. You should know the formula. Here there is one more catch. In ICA material, in summary, they have also given information about the reserve money NM1, NM2, NM3, NM4, L1, L2. Till date, the questions have never come. But before going to exam, make sure that you are reading that and going. ICI BOS Knowledge Portal. One sec. Let me show that. Why I usually say students to read ICA material including summary is this is the reason. One second. Economics. Chapter 8. Unit 2. Concept of money supply. Wait. Let me show that. See here. They have just explained about M1, M2, M3, M4, right? Now, at last, when you come to the summary. Yeah. Can you see here? Following are the recommendations of the Working Group of Money 1998. The RBI has started publishing a set of 4 new monetary aggregates. In that, first and foremost, reserve money. That M1, only the second component changes here. Currency notes in circulation plus bank deposits with RBI. Clear? Instead of CASA deposit part, bank deposits with RBI and other deposits, same to same. So you should remember this reserve money and also NM1, NM2, NM3 formula, L1 and L2 formula. Till date questions has not come, but the high chances are there of asking. Sometimes ICA does ICA things. From the main content, there won't be a question. From summary, they will ask you a question. In next unit, it is there. In chapter 9 also, cross rate, exchange rate mechanism, and the concept of CRR and SLR that was given by the Narasimhan committee. There was one question that is there in summary. So sometimes the question will be picked from summary. That's the reason after reading ICA material, once you have to read summary like a newspaper. So in this concept, NM1, NM2, NM3, L1, L2, along with reserve money, at least you should know the formula. What is it all about? So reserve money calculation, they may give it. So anything may ICA decides to screw up your happiness for just 1 or 2 marks, they may ask it from this area. So at least go through it like a newspaper once. Don't ignore this. Clear? So mainly from the exam perspective, M1, M2, M3, M4 is important. M1 is called as a narrow money. M3 is called as a broad money. Most liquid M1, least liquid M4. This at least small knowledge wise, you should be remembering this. Clear? So this is M1, M2, M3, M4 calculation. This is where most of the questions will be. And next, money multiplier and money supply. Now this is most interesting. Especially money supply, money multiplier. Repeatedly the questions will come in the exam. This is where the numericals will also come from. Let me make your life more simple, more simplified here. See, to understand the concept of multiplier and money supply, we need to understand the behavior of 3 elements. One, central bank behavior. Second one, commercial bank behavior. Third one is general public. That is why we call it as combined behavior to understand the money multiplier approach. That is behavior of central bank, behavior of commercial bank, behavior of general public. So what is this behavior? Now understand, we always expect central bank to print more currency and circulate it into the system. That means the very first one, central bank behavior in terms of printing and supplying high-powered money. We believe that central bank will print more money and that will circulate into the system. That money will get into a circulation, money supply will increase. Second one, to increase the money supply, even the behavior of a commercial bank is important. We believe whatever the central bank has instructed, like this in my previous example, keep a reserve of 10%. We believe commercial bank will only and only keep 10%. They will not show any extra talents like keeping another 2% extra, another 1% extra, excess reserves and all. We believe that they will not keep. They only and only maintain required reserve. Sometimes they may also keep an excess reserve. So this will become total reserves. Clear? So if I have to only identify excess reserve, simple, total reserves minus required reserve. Let's say total they had kept a 12% of reserve, but RBI asked them to keep only 10%. So our excess reserves is 2%. We believe that commercial banks are not going to keep excess reserve over and above what RBI has instructed them to keep as a required reserve. That is what we believe. But every time your belief will not work. Commercial bank will keep excess reserve. So that is what we calculate as small e. How do we calculate the small e? Excess reserves divided by deposits. This is the formula. And if you see ICA material, the small e instead they will give it as a small r only. R is equals to ER by D, but that is actually wrong. Here R means required reserve ratio, RRR. We believe that they don't keep excess reserve, but sometimes they will hold excess reserve. So I have to write it as E only. Next, the third behavior is a general public behavior. We believe general public will not keep more cash in hand. Rather than keeping money in hand, they will deposit in bank account, because if that money comes to bank, that will undergo a multiple circulation and expansion. But if you simply keep money in your hand, what will it put extra 10 rupee note for every 100 rupee note? No, it will not put the 10 rupee extra note. So we believe that general public is not maintaining excess cash in their hand. Cash to deposit ratio, we call it as, that should be always lesser. That is small c. The small c is capital C divided by capital D. Capital C is a cash in hand. Capital D is a deposit made by public in the bank. So the C by D ratio should be always and always lesser. We want people to deposit more money in the bank, hold less cash in the hand. So these are the three joint behavior. General behavior of all the three people is, we believe central bank will print more currency and they will circulate. Whatever they print more currency and circulate, commercial bank will not maintain this money printed and circulated as excess reserve. Public will not keep more money in their hands, whatever they are printing and circulating. If these two behavior assumption applies, that means they don't maintain excess reserve, they don't maintain excess cash, then automatically money supply will increase in the economy when they print more currency and circulate. So this is what is the belief. So the formula for money supply, total there are two formulas. First and foremost, we call it as MS is equals to small m into MB. MB is a monetary base, high powered money. So multiples of monetary base. We call it as what? Multiples of monetary base. By using the same formula, we can identify multiplier also. See now, small m is equals to MS by MB. This is what you have to remember the most numerical problems, whatever comes in exam, this is from this MS by MB. Or else, if you are still keen on to understand from a very simplest perspective, remember reciprocal of RRR, required reserve ratio. That's it. Clear? There is one more formula, interesting formula. Money supply will be 1 plus small c divided by R plus small e plus c into H. H is high powered money. In the same formula, if you just eliminate H, that will become multiplier. Small m is equals to 1 plus c divided by R plus e plus c. That's it. These are the formulas which you have to remember. And especially from the exam perspective, this first formula, MS by MB, this is what you have to remember the most. Sir, I understand the concepts of all the lessons, but I fail to solve exam questions. I only get a few correct, even though I do very right even after the lessons. See, there are two problems in it. Number one, after knowing the concept before answering, you have to be 10% sure whether this option is an answer or not. Even if you have a slightest doubt, go back, open your book, read it, and then mark answer. After marking answer, see the answer key. Still, if you are wrong, see the explanations of the answer. Understand why you went wrong. Was your understanding capability wrong, or was the interpretation of question wrong? Usually, interpretation of question will be wrong. Sometimes options will be very close, very similar between each other. There, very minute details of understanding and eliminating the wrong one, that is where it takes little time. Over a practice. Harsha. Okay. Chalo. So this is the main formulas. Let me show the numerical problems for you so that you can solve it. Now, see here, question number 72. If the monetary base in an economy is 250 crore, through open market operations by the central bank, the money supply is 1000 crore. See, this is MB, monetary base. This is money supply, This is MS and this is MB. And they're asking us to calculate what? Multiplier, MS by MB, simple, 1000 divided by 250. 4 is the answer. Next, Jan 25 attempt paper. See here. consider that with the money multiplier as 1.5. Already they have only given the money multiplier. There has been an increment. Okay, wait. Considering that the money multiplier is 1.5, there has been an increment of 600 crore in money supply. That means this is money supply. Find out monetary base. They are asking us to identify the MB here. It is much more simple. See, money multiplier, small m is MS by MB. Already they have only given multiplier. 1.5 is equals to 600 divided by MB. Simple. MB will go to LHS, 1.5 will come to RHS denominator. So this will be finally MB will be 600 divided by 1.5. Answer is 400. See, most of the questions are coming from MS by MB only. Let me show. In every attempt, let me show. No. Here M1 calculation as there. To May 2025, there was no question. See here. If the money supply is 1000 billion and monetary base is 200 billion, what is money multiplier? MS by MB. Money supply is 1000. Monetary base is 200. 1000 by 200, answer is 5. Chapter 8. Jan 26 attempt. Okay. The money multiplier will be larger. Which of the following scenario? All those ratios, whatever I spoke, a small c is equals to capital C by capital D, or excess reserve 1, the small e is equals to ER by D. All these ratios are smaller. See, smaller the currency to deposit ratio. When ratios are smaller, money multiplier will be the larger. That is the main logic over there. So either theory questions will come and numerical questions will also come. Numericals are most easiest in chapter 8. All you need to know is a proper logic there. I'm just checking, is there any other question? This is credit multiplier question. We will do it. We will do this later. 1 second. See, MV is equals to PT. That MV plus M dash V dash, credit money and both actual money put together. Okay. This I will open and I will keep. Yeah. Recent one, May 26 attempt paper. Okay, this is required reserve ratio, credit multiplier question. This also will do it later. Credit multiplier, when I come, I will explain there. See there, if the money supply increases by 750 crore because of there is an injection of 250 crore through open market operation. Clear? This is monetary money supply increased and this is monetary base, MB. This is 250 crore. And calculate multiplier. You tell me, what is the formula of multiplier? Small m. Small m is MS by MB. Here MS, money supply 750 crore. Monetary base 250. 750 by 250. Answer is 3. Calculate currency with public. See, currency of rupee coins added. Currency of small coins added. Note in circulation added. Cash on hand with the bank. Subtracted. Add the first 3. Subtract the last one. Simple. See, to be frank, chapter 8 is one of the most easiest numerical questions what you will get. Chalo, fine. We'll go back. Okay, so this is related to money supply and money multiplier. There can be one more type of a question which will be asked in the exam. Let me explain it. Yes, this Grady's land, that 1 plus C divided by R plus E plus C. See, they have only given the R. R is 10%. Currency in hand 400 billion, deposit 800 billion, excess reserve 0.8 billion. Sometimes see, they may not give you the 0.8. They will just give it as 800 million. See, here it is in billion, here it is in million. You have to convert this million to billion. See, 100 crore is 1 billion. 10 lakh is 1 million. So you have to convert that. So 0.1%. Always remember this. 1 crore. If it is 100%, 0.1% is 1 million. See, 1 second, sorry, not 1 crore, 100 crore. 100 crore. This is called 1 billion. And 1 million is 10 lakh. That is 0.1%. out of 100 percentage. So 0.1 in the decimals, we will represent it as 0.01 into this 800. So this will become 0.8 billion. See, even you should be knowing how to convert it. 0.8 billion. They have only given it, but still they may not give it. You may have to convert it. Clear? And excess reserve is given 800 million. Money supply total, currency plus deposit put together 1200. Now they are asking us to identify money multiplier. So multiplier formula, small m is equals to 1 plus c divided by r plus e plus c. Now 1 plus c, currency, they have only given 400 billion, but we have to identify small c. That small c is capital C by capital D. This is capital C, capital D. So this is 400 by 800, 0.5 automatically. So this is 0.5 divided by, wait, I will take this aside. R, they have only given 10%, 0.1 plus E, C 0.8. Just now we identified, na? So that is excess reserve value. So excess reserve value, what did we say? E is equals to ER by D. So 0.8 divided by 800 billion. So this will be 0.001. So 0.001 plus C. Just now we identified na C 0.5. So that's it. This is the value. So this will be 1.5 divided by 0.601. So end result, this will be 2.5. 2.5 times. Clear? This is how the questions can be. And see, individual explanations may come. Like I explained a joint behavior of all the three. The very first one, behavior of central bank. We believe that central bank will print more currency and circulate. At that point of time, commercial bank behavior and general public behavior assumed to remain unchanged. Their behaviors will not change. Next, behavior of a commercial bank. We believe that they will not keep any kind of excess reserves. And central bank will always and always support for a commercial bank. And we believe that commercial bank always expects a people to hold more and more in the form of time deposits. See, this question is important. Once they have asked this question, why time deposits? See, if people come and keep money in time deposits, now that means your next 1 year or 6 months, you will definitely not touch that money. So a bank will be using that as a free reserves to give it as a loan. See, remember these words. Same word to word it will be coming. See here, greater availability of a free reserve and consequently enlargement in the volume of a multiplier deposit expansion and monetary expansion. Now see here, same to same question. What is likely the impact of increase in time deposits to demand deposit ratio? Higher availability of a free reserve and consequently enlarging in the volume of a multiplier deposit expansion and monetary expansion. Word to word, you have to remember the keyword. That is what I'm saying. Concept is important there. Concept, word to word has come. When you keep more money in FD rather than your savings account, next 1 year or 6 months, you will not touch that money. That money will become a free reserve for a bank to give more and more loans to expand the deposits. That is the concept there. Last one, behavior of a general public. See, general public behavior, we think that their habits are more and more towards of banking, not towards of a keeping cash in the hand. So all three combined behavior put together, we identified the concept of money multiplier. So in this, there is one more question they have asked once. Change in money supply happens because of change in reserve. Let's assume earlier RBI asked them to keep a reserve of 10%, 1 by 10%. That is 1 by 0.1. Now RBI asked them to keep additional 1000 rupees as a reserve. That means there is a change in reserve. Whenever change in reserve happens, that will also lead to changes in money supply. Wait, I will show the question. Yeah, see here. If the reserve ratio was 10%, that is 0.1 is 10%. If there is an increase in reserve, that means change in reserves by how much? 1000 rupee. What will be the change in money supply? So same formula, just now I explained now. Change in money supply will be 1 by R into change in reserve. So this is 1 divided by 0.1 into 1000. 1 by 0.1 is 10. 10 times of 1000 is 10,000. That's it. Nothing big there. So this will bring to the last topic, that is credit multiplier. Very simple. See, there are two things to understand here. One, credit multiplier, 1 by RRR. Just you need to remember this. If they create credit money creation into initial deposit, ID, initial deposit, whatever the initial deposit is there, how many times that money is getting circulated. See, let's straight away, let me go to the problem. See here. In this, we are expecting you to identify the credit multiplier along with credit money created. See there, what will be the total credit created, that is credit money created by the commercial banking system with the initial deposit of 3,000. If required reserve ratio is 5% and 8%. So formula is 1 by RRR, 1 divided by 0.05, 1 divided by 0.08. So in this case, it is 20 times. In this case, it is 12.5 times. So into initial deposit, how much is initial deposit? 3,000. That means in the first scenario, if required reserve ratio is just 5%, money will multiply 20 times. What is the 20 times? Initial deposit. So 20 into 3,000, this will become 60,000. And here 12.5 into 3,000, this will become 37,500. So either they may just ask you to identify this multiplier or credit money creation. Anything can be asked. See, recently the question was asked in the reverse calculation. First let me give you the proper calculation. Next I will come to reverse calculation. Yes, here. Given required reserve ratio is 8% and 12.5% and initial deposit is 1 lakh in the banking system. Calculate credit multiplier. For credit multiplier, I don't need this initial deposit at all. Only credit creation means I should multiply that with initial deposit. See here, just 8%. Now 1 divided by 0.08. Answer is 12.5. And 12.5% is 1 divided by 0.125. This is 8 times. So answer is 12.5 and 8. Here also numbers are also same. Percentage outcome is also same. For 8% answer was 12.5. For 12.5% answer is 8. So be careful. Clear? And next, see there. If credit multiplier, they have only given the credit multiplier 4. End value is given. Required reserve ratio is given. 1 divided by RRR. That RRR below, they are asking you to calculate. And already you know the answer. 44 is equals to 1 by RRR. Simple. Now it will be 1 by 4. What is 1 by 4? 0.25. That is 25%. That's it. Clear? See, such a silly questions will come. Okay, I will show one more question. Now you only solve it. Credit creation question I will show. Yes, this is the credit creation question. See there. Credit multiplier required. Required reserve ratio is 10% and 12.5. Initial deposit is 1 lakh. Identify the total credit money created. Now first take the 1 divided by RRR of both this. 1 by 0.1. This will be 1 by 0.125. This will be 8 times. This will be 10 times. So multiply that with initial deposit into 1 lakh into 1 lakh. So this will become 10 lakh. This will become 8 lakh. That's it. This is the concept of credit multiplier. By this, unit number 2 also comes to an end. This is unit 2. Clear? For M3, it is M1 plus, not M2 plus. Shenmuga. See you. Yep. So M3 is M1 plus, not M2 plus. Open market sale and open market purchase. Okay, see, simple concept. Open market sale and open market purchase. See, on behalf of central government, RBI will buy and sell a government securities. Now, simple logic. When should RBI sell the security? When people have more money, people are ready to buy securities. That is when they will sell. That means during the time of inflation. At this time, yesterday we wrote on flow chart. Now, where is that? See, observe. When an economy is there with an inflation, public debts will increase. That means now RBI is also selling a treasury bills or government bonds. When people have more money with their hands, RBI will sell securities. So people will purchase security, money will come inside the banking system from general public. That is when RBI will sell security. I will write here only. Sell securities to absorb excess liquidity. Whatever excess money was there with the hands of a public, to absorb that excess liquidity, now RBI is going to sell the securities. When economy is not performing well, when people don't have money, whatever you guys sold during good times, now RBI will come and buy that. Purchase back, buy securities. When RBI is only buying the security, money will go from RBI to general public. So buying and selling of securities. Selling will happen during inflation. Buying will happen during deflation. Clear? Sagar. Example, inflation rate. Yeah. So this flowchart, yesterday I explained it for fiscal. Monetary policy related comes in now. In unit 3, we will speak about this monetary policy, interest rate related examples. Clear? Okay. Let's go to the last unit. That is unit number 3, one of the smallest unit. Just 2 major topics are there, but in exam also from this 2 major topics only the questions will be asked the most. Okay, now monetary policy. Monetary policy is mainly classified into 2 major topics here. The topic number 1, monetary policy framework. Second one is organization structure for monetary policy decisions. So what is this monetary policy framework? See, in that framework, that means how the operations of central bank will happen, how exactly the transmission mechanism, interest rates and other asset prices will work, and what are the main objectives of monetary policy. So 3 topics are there under monetary policy framework. First one, objectives of monetary policy. Second one is analytics of monetary policy. Third one is operating procedure. This operating procedure is what is RBI concepts. Quantitative, qualitative concepts of RBI. And analytics is also called as transmission mechanism. Clear? So let us get started. The very first one, objective. Mainly there are 2 objectives, primary objective and other objective. Primary objectives are price stability and economic rate stability. See, we need to bring the price stability. All of a sudden prices should not go up. All of a sudden prices should not come down. Even the nation's performance like full employment, economic performance should be stable. It should not have fluctuation. Same way. There is a new addition to this. Third one, inflation targeting. And also now this exchange rate stability has been moved towards the primary. That is what I have given here as note. See here, exchange rate stability, and considering financial and exchange rate stability reforms, now it is gaining more importance. See, more and more greater importance. But inflation targeting is the last topic. See, the second topic, that is based on the Ujit Patil committee recommendation. Now inflation is also considered as a primary objectives of monetary policy. But in exam, suppose if the question comes, what are all the primary objectives of monetary policy? Forget inflation targeting, only consider these 2 as per your syllabus part. And rapid economic growth, debt management, moderate long-term interest rate, adequate flow of credit to production sector, all these are other objectives. So this is the very first topic. Now comes transmission mechanism, one of the most easiest topic. Whenever interest rate changes in the economy, how it will affect on economic activity and inflation in the country. There are 4 channels here. You have to remember the headings of the channel. Sometimes they will give an odd one out. Which among the following is not a monetary policy transmission, they will ask. Out of the 4 options, see, first and foremost, savings and investment channel. Second one is cash flow channel. Third one is asset price and wealth channel. Fourth one is exchange rate channel. Only 4 channels are there. Very simplest way of understanding them. See, you tell me, when will you save more money? In bank, if interest rate is more or interest rate is less? Interest rate is more, you will keep money in bank. If interest rate is less, who will keep, sir? You will take out. Same way, if interest rate is less, will you borrow more money or will you save more money? We will borrow more money. We will not save more money. See, whenever interest rate decreases, see, lower rate of interest on the bank deposit, that reduces the incentives for the households to save money with the bank. But when there is a lower interest rate, now household people will come and borrow more money and they will go and invest it on their housing, their dream home, apartment to building constructions and all. But businessman, when there is a lower interest rate, he will come forward to borrow loan and invest it on his capital projects. Whichever big project he was waiting for to buy land, machinery, equipments and all, he will rather using his own funds, he will use general public money to run a business now. That is what savings and investment channel is all about. Next comes cash flow channel. Very simple concept. When does the money will flow inside the banking system? When does the money will flow outside the banking system? That is also mainly dependent on interest rates. Interest rate high, banking flow inside. Interest rate low, from the bank going outside. And asset price channel. When the asset prices are increasing day by day, now people's wealth will also increase. Suppose I bought one property, I bought a land in 2022. Today in 2026, its value is 1 crore. When I bought, it was just 20 lakh. Wow, nice. Now I will take the document as a collateral. I will go pledge that and I will borrow more loan. The more the asset value, the people's income will going to increase and their lifestyle is also going to increase. You can use that same document as a collateral to borrow more and more loan. See, higher asset price increases their equity to borrow money from the bank as a collateral. Same way, lower interest rate is there in the bank, asset prices are higher. People will come borrow loan and buy the asset. That is what our parents will do now. Dream home, let me say they want to construct, they want to buy some piece of land, all of this. Exchange rate channel. See, next in chapter 9, I will speak about this. At the moment, I will just give you the outline of exchange rate channel. See, simple concept. Let's assume $1 is 95 Indian rupee. Now this is becoming $1 90 rupees. This is called currency appreciation. That is domestic currency appreciation. When our domestic currency appreciates a lot, exports will fall, imports will increase. Complete opposite. When $1 becomes 100 rupee, this is called as domestic currency depreciation. When domestic currency depreciates a lot from India, exports will increase, imports will decrease. So this you need to remember, and here we are speaking about currency appreciation. Whenever in India interest rates are low comparing to rest of the world, in the entire world interest rates are high on investment, but in India interest rates are low. People will say tata bye bye to India. They will not invest in India. Whoever has invested, they will take back their money and they will say bye bye. They will go out. Now observe. Lower interest rate reduces the returns on investment from the assets in India. So lower rate of returns, demands for assets in India will go down, and reducing the interest rates will be the lowest exchange rate. That means exchange rate will become lower now, making foreign goods and services more expensive comparing to produced in India. That means we will stop importing. Sorry, here. Sorry. We will stop importing. Foreign goods and services becomes more expensive, or Indian goods will become cheaper. Depreciation, sorry. We spoke about that. Clear? So this part. A lower exchange rate adds more and more inflation because imports are becoming more and more expensive in Indian rupees. So this is the concept. Again, once again, the same thing we will explain it in tomorrow's class. Exchange rate mechanism. Clear? So that is the third channel. That is fourth channel, exchange rate channel. So these are the four transmission mechanism. First, savings and investment channel. Second one, cash flow channel. Third one is asset price and wealth channel. Fourth one is exchange rate channel. Now comes, this is where the most exam questions are going to come. Sir, I already watched your last May attempt marathon, whole marathon just now. Sir, what should I do now? Should I watch this marathon or should I solve more MCQs? Better to go with more MCQs. If you have not done PYQ, then you can watch this. After every chapter, important topics I'm doing with PYPs, that is previous year papers. Past 5 attempts paper I'm doing, sometimes 6 also. Few questions are there in the September 24. So I'm solving from that. The more MCQs will help you, especially RTP, MTP, PYPs and 9 mock papers of ICI and ICI material questions. These is mandatory, you should finish. Still you need extra question. My material questions are there, backside around 1500 to 1800 questions. In micro alone, macro another 1500 to 1800. Okay, chalo, let's continue. Operating procedures and instruments. So this is related to RBI concept. See, in RBI concept, there are two things. One, quantitative measures, and second one is qualitative measures. Under quantitative, we have reserve ratio and open market. Already open market operation I explained. See, that is buying and selling of government securities. When will RBI purchase security? RBI will buy security whenever there is a liquidity constraint in the economy. Economy is in the deflation. When economy is in the deflation, RBI will buy back the security when there is a liquidity constraint. When will RBI sell security? When there is a excess liquidity in the economy. When there is an inflation. On behalf of government, they do it. And why does this open market operation has to be conducted? Because of temporary liquidity mismatch, which has happened because of foreign capital inflow. This is important. And here, CRR and SLR concept. See, whenever the deposits are coming inside the bank, this part, they ask to keep a reserves now. This money will go with the RBI. So let's take up one more example for your better understanding. Assuming 100 rupee is received into bank account in the name of deposits. This gets divided into 3 parts. Let's say the very first part is CRR, cash reserve ratio. Let's assume out of this 100 rupee, some 10 rupee Now a commercial bank has to maintain with RBI. This is called as CRR, cash reserve ratio. And the second concept is SLR, statutory liquidity ratio. Assume some 40 rupees. They have to maintain it in the form of gold or RBI approved securities, liquid money for their day-to-day operations, and also RBI, one second, RBI approved securities, that is usually government securities. This bank has to keep with themselves. This is called SLR. And remaining money can be utilized to give loans and advances. In the given scenario, another 50 rupees. If RBI doesn't wants to give more loans, they will say, earlier you were keeping 10 rupee, now shut and come and keep 15 rupee. Earlier you were maintaining 40 rupee, now you maintain 50 rupee. 50 plus 15, 65. Now remaining loan money available is only 35. So like this, RBI can cut down that. So CRR, cash reserve ratio, portion of bank deposit which RBI should get the money from commercial bank, or commercial bank has to deposit with RBI, that is CRR. Portion of deposit which a commercial bank has to maintain with themselves in the form of gold or RBI approved security, that is called SLR. So this is required ratios, reserve ratios, CRR and SLR concept. Clear? And on this CRR, commercial banks will not earn any kind of interest. See, they will earn no kind of interest or profit, nothing. They don't earn. Clear? Next comes qualitative tools. Marginal requirement. Now let's say I have a property worth of 5 crore in corner site in Coimbatore. I will take that property papers. I will go to the banker. I will say the property is worth of 5 crore. Give me loan worth of 5 crore. Now bank manager will say we can't. What if like Vijay Mallya, you will take a loan and you will abscond? Possibilities are there, right? You are a stupid fellow. You may do this. So better we will only keep 80% as a loan. Another 20% we will keep it as a safety stock. Who decides the 20%? RBI. RBI time to time they will be changing on your collaterals. That means whatever we are coming to pledge, how much of safety stock we have to keep aside while borrowing. See that RBI prescribes a certain margin. That means safety stock against collateral. Like for example 20%, 15%, 25%, which in turn impacts the borrowing habit of a customer. That portion, whatever RBI decides, that you will not get as a loan. That means 20% you will not get as a loan. Only remaining 80% you will get as a loan. That is called marginal requirement. Moral suasion. Morally pressurizing. Morally persuading. See, recently I went to withdraw cash from my own account in Kotak Mahindra Bank. For withdrawing my own money, stupid fellow, they have levied charges. Withdrawal charges. I was like, stupidity. Yes. RBI is saying we don't want to encourage cash transaction. We want only online transaction. Even from your own account, if you withdraw money, we will levy the charges. Upon that charges, Nirmala Aunty share is also there, 18% GST. Everywhere Nirmala Aunty is looting. See, we know that people don't like it. Banks don't like it. But still you have to shut and follow that. Whatever I have saying, you have to follow that. That is called moral suasion. Morally persuading. Morally pressurizing commercial banks to follow instructions set by RBI. See, like for example, in this CRR concept, see, you have to keep it only in RBI approved securities only. That is government security, not in any other security. Even though it provides a better returns, you can't keep like this. Morally pressurizing. Selective credit control, for which business to give loan, for which business not to give loan. So go and take a loan for CA, CS and CMA coachings. You will never get. For engineering, BCom and all, you will get. Even though you are unemployed, you are going to get it. They know how to recover it back. But competitive exams and all, we don't give a loan. Like this. For what purpose loans to be given, for what purpose loans not to be given. Speculative purpose, gambling, betting purpose, loans cannot be given. So RBI will decide, select the credit term. That means for only selected industry and for specific business, not for every business. Speculative business and all, they don't give a loan. Next comes market stabilization scheme. See, earlier we had this concept of market stabilization, but presently we don't have. The concept name is called bank rate. See, earlier commercial banks could have borrowed a long-term loans from the RBI. Now this facility is scrapped. It is no more existing. Now if at all you don't maintain this proper CRR and SLR, this proportion, for levying a penalty, we use this bank rate. This bank rate is now called as a penalty rate. Prescribed penalty for not maintaining proper CRR and SLR. Earlier, to borrow the long-term funds from the RBI, commercial bank used to get that through a bank rate. But now it is no more existing. Now everything is controlled only through LAF facility. Liquidity adjustment facility. Kindly mark this as important. Under this, we have a repo concept and reverse repo rate. Repo rate means lending rate of RBI. When RBI lends loan to commercial bank at a specified interest rate that is only for a short term, that is called repo rate. Whenever RBI grants a loan to commercial bank for a shorter duration of time, usually 2 weeks, 14 working days, by accepting a collateral security as a repurchase agreement, that is called repo rate. Reverse repo rate, completely opposite, borrowing. RBI will only borrow. Borrowing rate of RBI. When commercial banks have more money, excess liquidity, commercial banks can keep that funds with RBI. For that, RBI will only give an interest rate. In simple practical terms, if I have to call, RBI is only borrowing money from the commercial bank. That is called borrowing rate. That is called reverse repo. Reverse repo is always 1% lesser than repo rate. This is important. You need to remember. And this repo rate is a short term. Earlier, there was a long term facility, but now it has been scrapped. No more existing. That is called bank rate. Clear? Okay, sir. First time the bank will come, we will help under the concept of repo rate. Once again, if they come within that 14 days, even before giving back this money of repo, whatever they have taken, once again, if they come, will they help? Yes, but not under LA facility. This time under MSF facility, marginal standing facility, but not under this repo rate concept, 1% more than repo rate concept. Repo plus 1%, that is called MSF. And even that money, we will not give unlimited money and all. Maximum, whatever you are supposed to keep SLR, 1% of that SLR money. See, MSF rate can be a maximum of 1% of your SLR security. Now, these informations are important. This formula and this maximum of 1% of SLR security can be given as MSF rate. This is where exam questions will be asked. This is what is important. This is the concepts of RBI, qualitative and quantitative. Under quantitative, we have open market operation and required reserves. That is CRR and SLR. Under qualitative, we have moral suasion, we have marginal requirement, selective credit control, market stabilization scheme, liquidity adjustment facility. Under liquidity adjustment, repo rate and reverse repo rate. In this reverse repo rate formula is repo minus 1%, MSF rate, that is marginal standing facilities, repo plus 1, that is 1%, maximum of 1% of SLR security. This is the main important element of the chapter. Clear? So last topic of the chapter 8, that is inflation targeting concept, organization structure for monetary policy decisions. Clear? So now Reserve Bank of India and Government of India, both of them have entered into an agreement called as Monetary Policy Framework Agreement. As per this agreement, now they are trying to achieve a inflation rate, targeted inflation rate. See, once in 5 years, see, suppose if anyone is watching this marathon by chance, in 2027, after January, from May 2027 attempt, you have to go with the latest material because the datas and figures might have changed. So if anyone is watching this marathon, after January 2027, the exam which you are watching this for, suppose by chance if it is May 2027 exam, then the datas will change. Don't follow this blindly. Clear? Once in every 5 years, now RBI and Government of India has come up with the inflation targeting. Presently, as per the syllabus which is applicable for September 2026 attempt exam, is from the August 5th 2016 to 31st of March of 2021. They say we need to achieve a target of 4% consumer price index inflation, CPI inflation. 4% is a target with upper tolerable limit of 6%, lower tolerable limit of 2%. Suppose, sir, what if we don't achieve this 4% or achieving more than 6% if it goes or less than 2%, that is called as failure. Then how exactly we consider it as a failure? In any 3 consecutive quarters, boys, not the quarter what you are thinking. We are speaking about every 3 months, like April, May, June is quarter 1, July, August, September is quarter 2, October, November, December is quarter 3, January, February, March is quarter 4. In any 3 continuous quarters, see, average inflation, if it is more than upper tolerable limit in any 3 consecutive quarter, that is called as a failure. Same way, in any 3 consecutive quarter, if the inflation target is less than lower tolerable limit, it is called as a failure. So we try to achieve the target. And there is one more beautiful information. This will be an exam question. Once in every 6 months, RBI will publish a report called as Monetary Policy Report every 6 months. It speaks about sources of inflation, from where exactly we are getting the inflation for the next upcoming 6 to 18 months. This highlighted areas are important one. This inflation targeting is not just followed in India. This is also followed in other countries like New Zealand, USA, UK, European Union and Brazil. Going further in future days, Like how we are having a inflation targeting as a concept, in further days also we will come up with a nominal GDP targeting for growth rate. This was your chapter number 8. Clear? So inflation targeting concept under monetary policy framework agreement. There is also a committee called as Monetary Policy Committee, MPC, which has been set up. See, under that monetary policy committee, we are working, and this entire inflation targeting has to be considered as a primary objective. This was suggested by Ujit Patil committee. Which committee? Ujit Patil committee. And this concept of CRR and SLR was introduced by Narasimhan committee, which is given in the summary. In the same unit number 3, in summary it has been given that LAF facility, liquidity adjustment facilities, all that, repo rate, reverse repo rate, all of this was recommended by Narasimhan committee. Wait, let me show the question only. Once they have asked a question from this area, man. See here, question number 52. Liquidity adjustment facility, that LAF facility was introduced by RBI on the basis of recommendations of Narasimhan committee on the reforms of the banking sector. This information, this Narasimhan committee information is given in summary, not in the main content like that. Next, they may come up with a question about this Ujit Patil committee, who recommended to have inflation targeting as the primary objectives of monetary policy. That is by Ujit Patil committee. They may come up with a question like this. And what does RBI publish as a report once in 6 months called as monetary policy report? That will have a source of inflation for the next upcoming 6 to 18 months. Clear? So this is the main information of chapter 8. By this, entire chapter 8 comes to an end. Any specific doubt in any of the topics of chapter 8 before moving into PYQs, previous year questions, or YouTube live students? Okay. Chalo. Chapter 8. Already we solved this also. Which of the following is not a function of money? Easily reproducible. No, not easily reproducible. Who gave the concept of aversion of risk? James Tobin. What type of currency is issued by the central bank? Fiat money, materially worthless. What is the formula of excess reserve? Total reserves minus required reserves. What will RBI publish once in 6 months? Monetary policy report. Reverse repo rate is repo minus 1%. Real money, nominal money adjusted with the price level. Same like GDP deflator concept. Nominal GDP, real GDP. Clear? This is September 24. Next, Jan 25 term paper. Which of the following is not a characteristics of money? Easily reproducible. No, not easily reproducible. Currency issued by central bank is called fiat money, high powered money, monetary base. Next, already we did this numerical problem. M1 also we calculated this. Penalty rate. Just now I said the concept of penalty rate earlier. Bank rate has been now converted as a penalty rate. Under which facility? MSF facility, marginal standing facility. See, MSF is the penalty rate at which RBI lends banks over and above the concept of repo policy. Don't go and write answer as bank rate. Earlier it was existing, but now it is no more existing. This bank rate is only now called as a penalty rate under MSF facility. Next, LAF facility. I said Narasimhan committee. Money created by commercial bank is called as credit money. The term public does not include bank and governments. They are not the producers of money. Sorry, they are the producers of money. Producers of money is not under the definition of banking system. See, this is credit multiplier questions. Here, calculate the total credit money created. Leave out multiplier. Credit money, that means 1 by RRR into initial deposit. So we should make into initial deposit. Initial deposit is how much? 12 lakh. RRR is 15%. So simple. 1 divided by 0.15 into 12 lakh. 80 lakh is the answer. Next, currency with public. Already we solved it. That's it. So, time deposits, already I spoke about. Liquidity trap. When interest rate becomes almost zero, people wants to hold cash in hand rather than over as a bond. M1 is not included. Which of the following is not included in M1? Time deposit, because that comes in M3. Next, I said, what does the term Y represents in MD is equals to proportionate of PY. This comes in second theory, Cambridge theory. Y is a real national income. PY is a nominal income. K is a proportion. This already we did public definition. What is that maximum MSF rate? That is over and above repo rate. What is the maximum of MSF rate that we will provide? 1% of statutory liquidity ratio. 1%. That's it here. Chapter 8 here. Which monetary tool is used to check a temporary liquidity mismatch because of foreign capital inflow, open market operation? I just underlined that word. I asked you to remember. Be careful. Remember is what I said. See here. To keep a temporary liquidity mismatch in the market owing to foreign capital flow. See, owing temporary liquidity mismatch to market of capital, foreign capital flow, open market operations. M3 calculation. In M3, first M1 calculation. Currency notes and coins, yes, added. Demand deposits, added. Total post office, no, it comes in M4, subtracted. We don't want it. We don't want to consider at all. Time deposit, yes, add it. M3, it comes under savings deposit of post office. No, that comes under M2. So we don't want this last one and this one. Only these three should be added. 1, 2, 3. Next. Speculative demand for money becomes perfectly elastic liquidity trap and it is parallel to x-axis. Next, according to Milton Friedman, how does the price level as a determinant affects the nominal demand for money? According to whom? Milton Friedman. What did Milton Friedman said? Future incomes, present value. When there is a rise in price level, that increases the demand for money. When price level of the asset goes up, demand for money will also go up to buy that asset. MSF rate. See, repo plus 1 MSF is also correct. Repo plus 1 is also correct. Here instead of giving plus 1, if they have given properly MSF rate like this is only actual correct is option 1. Here only and only option 1 is not there. So along with 1, we should combine with 3 plus 1. So 1 and 3. What is the primary objective of monetary policy in most country? Price stability and economic growth rate. Inflation targeting was added later. Next, already we did this. Which of the following statements are true with respect to cryptocurrency? Crypto, is it legally recognized in India? No. See here, they have achieved significant legislative recognition. No legislative recognition. They are not legally recognized in India as a currency. Yes, they are not legally. They are not classified as a money. No, they are not at all categorized. Correct. In India, that serves as a legitimate measure for payment. No, we can't accept it as a payment. 2 and 3 is correct. Yes, 2 and 3 is correct. Okay, which of the following is not a quantitative tools? By the way, what are the quantitative? Open market operation and required reserve ratio. CRR, SLR. See, CRR, SLR. Open market operation. Selective credit control is qualitative, not quantitative tools. We did this already. See, for the initial deposit of 6 lakh, credit creation is calculated as 50 lakh. They have only given the answer. Credit creation. See, what was the formula? Credit creation is 1 by RRR into initial deposit. This was the formula. Credit creation, they have only given 50 lakh is equals to 1 by RRR. So required reserve ratio is what we have to identify. RRR should be identified into initial deposit 6 lakh. So simple, 1 into 6 lakh is 6 lakh only. So this will become like this. 50 lakh is equals to 6 lakh divided by RRR. RRR will go to LHS, 50 lakh will come to denominator RHS. So simple, RRR is equals to 6 lakh divided by 50 lakh. What is 6 by 50? 0.12. That 0.12 is nothing but 12%. That's it. January 2026 paper. Chapter 8. Which of the following is not a channels of monetary policy transmission? Savings and investment channel, yes. Exchange rate channel, yes. Cash flow channel, yes. Asset price channel was there, not open market channel, wrong. Next, speculative demand for money can closely link it to watch which of the following situation? Attractive investment opportunities in future. For that purpose, we need speculative demand for money. MV plus M dash V dash is equals to PT. James Tobin, liquidity preference function, framed a relationship between which of the following: rate of interest and demand for money. That is continued by Keynes only. This already we solved. See, literally easy questions. There is no difficult questions at all. The optimal average money holding is negative function of which of the following: nominal interest rate. If interest rate is more, you will not keep money in the hand. Opportunity cost will be there, na? When bank interest rates are high, bond market interest rates are high, are you mad fellow to simply keep money in your hand? So money holding, average money holding will become negative with interest rates. But transaction demand and precautionary demand has positive relation with income. When you earn more, you will save aside more. Next. When the RBI uses persuasive, that is morally persuasive measures to convince banks to hold only in government security, moral suasion. Same examples I give. Who is responsible for determining the inflation target for RBI under the monetary policy framework? Both central bank in collaboration with RBI. Which action does central bank performs during open market operations to introduce high liquidity? Introducing high liquidity, that means we are flowing money into the system. That means we are purchasing the securities. When we purchase security from RBI, money will go into the system. So purchasing of government security. When you sell security, people will buy. So money will come from people to bank inside. But here we are introducing high purchasing money into the economy. We are putting money into the system. That means we will purchase. RBI will purchase back. See, money multiplier would be larger in which of the following? When all that currency ratios are, sir, already I spoke about this. That's it, chapter 8, last paper, May 2026, the recent attempt paper. Okay. Controlling credit by not introducing any selective industry. That means for a particular industry, we should not give it all speculative business. Which is that? Selective credit control measures of RBI. Qualitative tools. Already we solved this. Okay, which of the following is the rate set by the monetary policy framework, and it should be a maximum tolerable, minimum tolerable, which rate? Inflation rate, na? Achievable inflation rate, target, maximum tolerable, lower tolerable. Next, this also we solved it already. The degree of adoption of banking habit by the public, whether public is keeping money with the hands or money with the bank, that banking habit is calculated by currency to deposit ratio, that small c, capital C by capital D. If that ratio is more, that means people don't have more banking habit. If that ratio is less, that means people are not willing to keep cash in hand, rather they are willing to keep money with the bank. LR is equals to proportionate of income. This is Keynesian theory, transaction demand for money. Next. See, May 26 attempt paper, recent attempt paper. What is the target set by the Government of India and the RBI for achieving the inflation between August 5th, 2016 to 31st March 2021? 4%. Upper tolerable 6, lower tolerable 2, but achievable. CPI inflation is 4. Interest rate liberalization and reduction in the controls on the bank in India by the Reserve Bank of India with regards to interest rates chargeable on loans and payables on deposits are closely associated to which of the following economic reforms? This is monetary and financial as well as monetary reforms, both, 1 as well as 2. Suppose in your example, if the financial is not given, most appropriate answer is monetary reforms. Which of the following is not a general characteristics of money? It is not perishable, but they have given perishable. So it is effortlessly recognizable, yes. Easily transportable, possess uniformity, yes. All these three are correct, but this is not a characteristics. That's it. Yep. By this, even previous questions of entire chapter 8 comes to an end. Katam. Clear? So every day, whenever we are getting time, we are also doing that chapter 10. If you remember, yesterday I did until the 1980s. If you remember, I spoke about this. I gave a background about till 1980 what happened. But 1980 and later is also important from the exam point of view. That is where most important point of it. So I will just give you the background. Like what all have to be studied. What all are the elements. See, era of reforms by Stilt. I explained this entire. See, anywhere the questions can come. All this. MRTP Act, Mod VAT, SEBI got its powers in 1992, but SEBI was established in 1988. After Arshad Mehta scandal, they got the powers. OGL, full form, Open General License, all of these are important. Private sector reforms underwent a resolutions and all the changes was made in 1991. So year after now, especially 1991, this is crucial in India. So this is where most of the things gets interesting. See, in India, we just had 1.2 billion of foreign exchange reserves for importing essential imports. That was only sufficient for 2 weeks. This is where the crucial turn happened. At that point of time, PV Narasimha Rao was the Prime Minister and Manmohan Singh was the Finance Minister. So they went and asked a loan with IMF. IMF agreed to give a loan, but 3 simple conditions. See, boss, in India, in your country, rules and regulations are very strict. For private people, you are not at all giving freedom. Everything is controlled by your PSU. Only if you liberalize your rules, I will give loan. And if your PSUs, whoever is not working well, Allah, sell them to private. Privatization has to be made more and more. I will give loan. And no more closing countries, doors and all. Full, you have to open up the gates of your country. You have to treat entire globe as a one single market. Globalization practices. So LPG. Liberalization, privatization, globalization. India didn't had an option. No other countries agreeing to give a loan. So we had to follow this. That is when we made a big changes into our financial reforms, monetary reforms, industrial reforms. Every reforms we started bringing in 1991. See, very first one, fiscal reforms. Whatever the deficits, what we had, whatever problems we had with finance, tax system, entire thing got re-changed in 1991. See, introduction of new slab rates, transparency in tax system, ensuring better tax compliances, and curbing all unnecessary government expenses, reducing subsidies and unwanted subsidies. And whatever the government assets, whatever the government, let me say PSUs which were not working well, OLX may bech do, disinvestment of PSU stakes, encouraging more and more private participation. All this we did, and RBI also started giving more private bank license only after 1991. See, monetary sector reforms. We liberalized and interest rates in India, and we also depreciated our Indian currency. And remember, this one point is most important. I will speak about this now. See, interest rate liberalization and reduction in the control of banks by Reserve Bank of India. We opened more and more private banks in India after 1991. We introduced this concept of CRR and SLR. We reduced the rates and liberalization to open more branch license. And also SEBI got the powers in 1992, even though it was established in 1988. But powers was given in 1992 after Arshad Mehta scandal. And new industrial policy reforms. So in this, we made a major changes in industry. Earlier, 18 plus, let me say majority, not even 18 plus, majority of the industries was only exclusively reserved for PSUs. First, we brought it down to 18 and we started ending that license raj. For earlier, each and everything you should take license. We ended that regime, and from 18, later we brought it down to 5. Now only presently 2 as per your syllabus. Railway and atomic energy. But railway is also open for privatization at the moment. In reality, it is only atomic energy. And public sector were limited just for 8 sector. Later it was brought down to just 2, railways and atomic energy. Earlier we had MRTP Act. We repealed it and we replaced it with Competition Act of 2002 for all these mergers, acquisition, takeovers, competition based policy for all of this. And small scale industry, we made 800 items reserved. Only and only small scale can produce now. But those stupid fellows, even though it was high export potentiality, they were unable to produce. Now we de-reserved. We don't want. Anyone can produce it. And also the number of areas reserved exclusively for public sector was brought down. Now it is only 2. As I said, earlier it was made it to 18 from 5 and again brought it to 2. Foreign investments was liberalized. Until 1991, we never allowed foreign companies nor the foreign funds to enter India. But only after 1991, External trade was further liberalized. Slowly we started reducing rules. See, earlier tariff rate was how much? 355 in 1991. Later we bought down to 85, 50, and recently 2007 and 8 only we bought it down to 10, and we devalued our Indian currency by 18%. We reduced its value, and disinvestment, OLX may beige all the government holdings in PSU stakes, whichever is not performing well, even trade policy reforms, and also export duties and all. See, this highlighted one is important. Tomorrow we'll speak about this. In India, till 1991, we were following a fixed exchange rate regimes. But from 1993 and onwards, India started following a floating exchange rate, especially managed float. And after 1991 till now, what all we have done in this 30 plus years, this example, this is where exam questions will come. From any nook and corner from this area, they may pick up a question. All of this poverty was eradicated, blah, 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 full on. See, in this anywhere nook and corner questions can be asked. And we had something called as 5-year plans. We scrapped it. By scrapping that 5-year plans, we replaced it with Niti Ayog. Now, mid to long-term projection, 15 to 20 years of long-term planning, Niti Ayog was replaced. But the problem after replacing Planning Commission is Niti Ayog didn't get more powers. Nirmala Aunty Department got more powers. Finance Commission, all this Finance Ministry. Niti Ayog will be just acting as a think tank. They will be also a part of long-term economic planning wherever earlier Planning Commission has not focused. Now it will focus not just on the country's level, even every state level, inside the district level, inside that village level. Wherever planning was not considered alarm, there Niti Ayog will consider it as acting as a think tank, and will also include state governments also. See all those highlighted words here. These highlighted words, go through it like a newspaper. From this area, from this topic only, questions will come in the exam. And these are the problems, counterparts of Niti. And especially this is where all this point, 13 points, what is given here, this is where exam questions are going to come. Clear? So this is related to Niti Ayog. Full, entire read-only concepts these topics are. Full on. Nook and corner, anywhere they will touch the questions. No, international trade, I will touch it in tomorrow's class. Chapter 2, tomorrow last day. Chapter 9, we will finish it off tomorrow. 5 units are there. Interesting units. Every unit may take 20 minutes to half an hour to finish it off. 5 units total, around 2.5 hours. We'll finish it off tomorrow. If I also do international trade today, it will be too much. So tomorrow is going to be the last class. Chapter 9, we'll wind it up. Clear? Okay, see here. In primary, secondary, tertiary sector. See, here contribution made to GDP, those informations are important, and almost everything is data and information here. Observe, primary and allied activities of primary. See, it contributes to 18.8% to India's GDP, and 47% of India's population is still dependent on agriculture for their livelihood in India. And all this, see, this index numbers and all, this is not required, leave it off. This informations are important. See, in India, I said now on 23 crops, 1.5 times minimum support price, price control measures, price cap, price ceiling, those topics. This is price floor, minimum support price. On 23 crops, 1.5 times, like this informations are important. What all India is trying to achieve with the agriculture, what all we have made a big changes, and especially this one, this is important. All this Pradhana Mantri dash 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 Yojana, per drop, more crop, Fasal Bima Yojana, crop insurance. From this is where exam question comes. This Inam, once they have asked a question, and problems faced by Indian agricultural sectors. Same logic here also. Secondary sector. What all are the contributions made? And secondary sector contributes for 12.1 crore people. 50% of gross value added comes from informal sectors who is not registered. And also whatever the contribution made by them. And DPIIT, Department of Promotion of Industry and Internal Trade, full form they have asked once. GST concept, Make in India, and ease of doing business. India's ranking presently 63rd in the world. These rankings are important. And one step window, National Logistics Program, Atmanirbhar Bharat, all this. And this electronic fame, electronic machines and all this. 100% FDI was introduced, foreign direct investment, and this one, remission for duties and taxation of exporting procedures. These questions have come. National logistics policy, and I said the industrial resolution 4.0 yesterday. 1.0 1948, 2.0 1956, 3.0 1991, 4.0 2005. We have to contribute 25% by the manufacturing in the GDP of the country by 2025. Did they do that? God only knows. See here, I will show the question. From that also the questions have been asked. All the small informations. See here, question number 99. Which of the following aims for national manufacturing policy to increase the share of manufacturing in GDP by 25% by 2025? Like this question, small questions also they will ask. Total 10 marks will come. So second half is where the majority of the questions will come. So the industry contribution to the GDP of the country. Wait, 30% here. This is the one. Agriculture 18.8, secondary sector, industry is 30%, remaining 58% something, 53 odd, service sector, and the fastest growing sector in the India, 53.89. See, usually any country for it matter, from agriculture they go to industry, but India that has bypassed the secondary and straight away from agriculture we have come to the trajectory. That means from primary we are coming to service sector. And these are the examples. See, what are all the achievements made in the service sector? Fastest growing sector in India. Even during COVID, we were booming like well. Top 10 service sector exports comes to India under WTO agreements. And all of this, just go through it like a newspaper. ROC concept. Read only concept. Sir, I omitted chapter 10. Can I omit this for exam? I recommend not to, because see, even if you just read it like a newspaper once, out of 10, easy to score 5 to 7 marks here. Just direct straight away, main questions only they will ask. Some twist and turns and all, some 2-3 questions they will do from nook and corner. Even if you have read like a newspaper, some 2-3 times you read it. Whenever you are free, whenever you feel bored, whenever you feel like throwing away the books of some particular chapters, take this up. Just read it like a newspaper. Full on data, full on information. For sure, 9 to 10 marks will come. So if you are okay to give back 9 to 10 marks to ICI, I don't want your donation, means you can skip this chapter. But I don't suggest you to skip 9 to 10 marks. And usually you know where exactly the question comes from. Second half of the chapter, that is where 7 to 8 questions will come. Hardly 1 or 2 questions will come from the first part. All that British India, ancient India, after independence of India, 1991 and later, that is where more than 7 to 8 questions will come. Sir, in which part micro, macro can be able to score more marks? See, to be frank, micro you can score really well. Macro, the biggest challenge is you have to go little in depth. You have to read ICA material from nook and corners also. Sometimes they will ask question. Sometimes some students, not for everyone, some students may find it little tricky for macro to score. But eventually, if you personally ask me, that trickiness is hardly 5 to 10 marks. So see, in micro, out of 50, scoring 40 is easy. In macro, out of 50, scoring 30 is easy. Definitely 80 to achievable if you have prepared well. Market, national income, Indian economy. National income to scoring paper, that is scoring subject, chapter 6, 15 marks. See, in micro, 2, 3 and 4. That is conceptually interesting and also high from exam perspective, more marks will come. Chapter 1, 5 marks, chapter 5, 5 marks. That 2 put together is just 10 marks. Remaining 40 marks in micro comes from 2, 3 and 4. And chapter 6 for sure 15 marks. 7, 8 and 9, 10. Remaining average 10, 10 marks, 10, 10 marks. That is how it will come. Chapter 6 to definitely 15 marks it will be. So sometimes they may pull it down like 7 marks or 8, 9 marks and they may increase it somewhere. That is how the questions will be. Clear? So tomorrow only and only one single chapter is pending, that is chapter number 9. So even before attending the class, read it once and then come to the class. Total there are 5 units. In that only unit 2 and unit 4 is slightly big. 1, 3 and 5 will get over very fast. It will not take much time over there. So tomorrow will be the last day of this marathon. Tomorrow also same time, 4:30 to 6:30 we will wind up. So by tomorrow the entire concepts will come to an end. Clear? So any other doubts? Your online live students. So you guys were asking, sir, chapter wise revision needed this time. That's why we are splitting and doing chapter wise this time. What is chapter 6? Hey, who is this? National income accounting and Keynesian theory. Clear? Chalo then. We'll wind up. Then we'll catch up tomorrow if you guys don't have any doubts. Yes, national income is chapter 6. Unit 1 is national income accounting. Unit 2 is Keynesian theory. In the 2-sector model, investment multiplier, leakages. That is the most important area. 3-sector and 4-sector, very few questions will come. But you have to remember the formulas there. Sir, once kindly explain the fiscal. See that fiscal, just you need to remember this chart. This chart will summarize everything there in unit number 4 of chapter 7 and unit number 1 also. So when there is an inflation in the economy, already people have more money. So we follow contractionary fiscal policy. That means government will spend less money, collect more tax. And budget will be surplus. Since we are not spending more money, but we are receiving more taxes. And we borrow money from the public at that point of time. Complete opposite during deflation. Already when economy is not performing well. So automatically now government has to spend more money, collect lesser tax. So we are spending more, but collection of tax is less. So there is a shortage deficit. So this two put together is what we call expansionary fiscal policy. Whatever we borrowed during inflation, we will give it back. Public debts will decrease. Sir, is that mandatory to write mocks conducted by ICI? Not mandatory, but I recommend you to write. See, the more new questions you solve, the more new varieties of questions you see. That is always good. And from mock paper, sometime RTP, MTP, straight away copy paste will happen in the main exam. Some 5 to 10 questions. That is one advantage. So that's why I recommend you to write it once. It's not mandatory, but recommended. For practice, is it compulsory? Yes. For practicing, I would definitely say compulsory, you should do it. Chalo then. Then tomorrow, sorry sir, fiscal deficit calculation. Fiscal deficit is simple. Budgetary deficit is there, na? Just remove that word. Only that one word you should remember. That is excluding borrowings. See, whatever the borrowings that we are making, that comes under the capital receipts. We have to just remove that one. See, shortcut. First, we will calculate budgetary deficit. Total expenditure is greater than total receipt. In this total receipts, now we will be having borrowings money. If at all we exclude that borrowings from total receipt, specifically from capital receipt, we will get fiscal deficit. Simple, same logic of budgetary deficit, just this one word gets extra added. We should remove that borrowings money. Sir, how to score marks in macro? For that, what all are the chapters to practice? 6, 7, 8, 9. 10 you can ignore, but I don't suggest you to ignore because equal weightage is there. 16 marks will come from the chapter 6. Sorry, 15 marks will come from the chapter 6. And most of them are numericals in chapter 6 and chapter 8. And easy numericals it is. Yes, in macro only. In micro, 2 and 4 is where numerical comes. Micro scoring, I don't think so anyone has an issue there. Microeconomics. Chapter 10, I'm explaining from 2-3 days, like what to be done, all those things. And tomorrow is the last day of the live, 4:30 to 6:30. Only chapter 9 alone is pending. Less of RTP, MTP. Start doing it. Still you have a time now, Team Guru. Start doing it. That will always benefit you. Chalo then, let's catch up tomorrow. Sir, this upcoming exam is my 3rd attempt so far. I have relied only on your marathon videos and class 12th basics without touching the ICA module. Can I clear the exam using just your study material? Clearing the exam, yes. I will only say yes. Up to 60 scoring, yes. With marathon and my material, up to 60 marks, even a fresher can crack it off. Provided if you have understood the syllabus, if you have understood the concept. If you're by-hearting and all, definitely that's not possible. Clearing is never difficult at all. See, that is when scoring above 60, scoring above 80 is where additional preparation needs. Just for clearing 40 above, 50 above, definitely sufficient. Mocks from our side, yes, it will be there. Arivu will conduct it. I hope it should be already done by now. Yep. Chalo then. Let's catch up tomorrow then. The last class tomorrow will be chapter 9. It will be done. So if anyone still doesn't have a conceptual clarity, if you are still finding it difficult with concept, better watch my Jan 26 marathon. That is 20 hours of marathon video is there. Sir, I have a conceptual clarity better with MCQs and marathon style I need it. Then May 26 marathon. Sir, only exam oriented, important topic and PYQs has to be covered. Then this marathon. Yes. Materials and mocks are enough. Yeah. Yeah, Muklin. Mukilen. Yeah. Chalo, bye. Then we'll catch up tomorrow.